On July 29th, 2026, the Dow plunged 1,100 points, the Nasdaq entered correction territory, and Treasury yields hit their highest since 2007. Wall Street's confidence in AI didn't just crack, it shattered. The reasons go deeper than one trading day. Trading opened to a wave of selling. The Dow Jones Industrial Average dropped more than 1,100 points before the closing bell, finishing down 2.2%. The S&P 500 fell 1.5%, and the Nasdaq 100, home to the market's most AI-exposed names, closed 11% below its all-time high, officially in correction territory. The damage wasn't limited to stocks. The 30-year Treasury yield surged to its highest level since 2007, signaling a rush out of both equities and bonds. Semiconductor stocks, which had powered the AI rally for months, led the rout. The sharp reversal in chip makers exposed how quickly optimism could turn to panic when the market's core narrative is questioned. On this day, the numbers told a clear story. Wall Street's confidence in the AI trade cracked across every asset class at once. Pressure had been building for months beneath the surface of the AI rally, but on July 29, 2026, a series of macroeconomic cracks became impossible to ignore. The Federal Reserve voted to keep interest rates steady at 3.5% to 3.75%, but the unity was only on paper. 3 committee members broke ranks, each calling for a rate hike to counter stubborn inflation. Their dissent sent a clear message. The Fed was divided, and the path ahead for monetary policy was uncertain. That uncertainty hit the bond market first. Yields on the 30-year Treasury spiked to their highest level since 2007, making it more expensive for companies to borrow and invest. For capital-intensive AI infrastructure projects, where billions are spent upfront in hopes of future growth, this meant higher financing costs and tighter margins almost overnight. At the same time, oil prices surged as conflict flared again in the Middle East, pushing inflation expectations even higher. The economic backdrop offered little relief. Second quarter GDP growth landed at just 1.5%, falling short of forecasts and hinting at a slowdown even as companies poured money into new AI capacity. Investors, already uneasy about the gap between AI spending and proven returns, now faced a world where money was no longer cheap and growth was no longer assured. The sell-off wasn't just about one day's headlines, it was the culmination of rising rates, inflation fears, and a growing realization that the AI trade might be running ahead of what the real economy could support. Semiconductor stocks took the brunt of the selling, dragging the entire market lower for a second straight day. The Nasdaq 100, once the engine of the AI rally, slipped into technical correction as chip makers, long viewed as the safest way to bet on artificial intelligence, suddenly looked vulnerable. The slide extended far beyond headline names. ASML, the Dutch company at the heart of advanced chip production, rattled investors with warnings about new competition from China. Even a hint that Chinese firms could close the gap in deep ultraviolet lithography was enough to erase billions in market value, raising urgent questions about whether ASML's technology lead and the rich profit margins that come with it could last. Underlying these market moves was a deeper anxiety about the economics of AI itself. OpenAI's leaked financials revealed a $20.9 billion loss for 2025 and a $3.7 billion cash burn in the first quarter of 2026, despite soaring revenue. The cost of scaling frontier models was outpacing even the most optimistic projections, feeding doubts about whether massive infrastructure spending would ever deliver sustainable profits. As chip ETFs recorded record inflows, the sector's sharp reversal forced investors to confront a new reality. Building the future of AI is expensive, and Wall Street now wanted proof that the returns would justify the risk. Investors searching for clarity on AI's future found only contradictions. Microsoft's cloud division posted its fastest growth in 4 years, with Azure revenue up 43% year over year and total cloud sales topping $100 billion for the first time. This surge offered a rare example of AI demand translating directly into top-line results. But even as Microsoft celebrated, Meta Platforms delivered a sharply different message. Despite record quarterly sales, Meta warned that free cash flow would fall below $1 billion, drained by ongoing heavy AI infrastructure spending. Its forward guidance left analysts questioning whether future AI-driven products would arrive soon enough to justify today's costs. The market's confusion deepened as core PCE inflation held steady at 3.3% annually, matching forecasts and offering no new signal to shift the macroeconomic narrative. Instead, attention remained fixed on the gap between AI investment and proven returns. Wall Street began to separate companies turning AI into real profits from those still chasing payoff, shifting the debate from blanket optimism to a more selective, skeptical stance. A correction is defined as a drop of 10% or more from a recent high, a technical milestone the Nasdaq 100 crossed as AI stocks tumbled. Now investors are left weighing whether this is a needed breather after months of relentless gains, or the first act of a deeper reset in tech valuations. The debate is not new. The dot-com bust, the 2021 tech pullback, and the 2008 housing crash all began with the same question. Is this just a pause or the start of something bigger? Each episode began with optimism that gave way to a sudden demand for proof of real profits, not just potential. Today's AI-driven market faces that same test. With upcoming earnings from the biggest tech firms on the horizon, the market itself becomes the judge. Will these companies show that massive AI spending can deliver sustainable returns, or will the correction deepen as doubts grow? For now, every investor must decide whether this moment is a buying opportunity or a warning to step back. Today, markets demand proof that AI can deliver real returns, not just promises. When fundamentals lag hype, capital retreats fast. For investors, conviction now meets its most unforgiving test.